So, Steve, what do we know about this latest move?
Yeah, this is not too much of a surprise. Of course, we've been digging into this issue quite extensively in our show, Red Lines. You know, obviously these big platforms and all the other ones as well, the second and third tier big tech companies in China that grew out from that big duopoly of Alibaba and Tencent now being caught in the net. So it pretty much shows that nobody is going to be spared in big tech in China from this regulatory push. Of course, it's probably more significant on the financial side because the government is trying to curb risks and the mushrooming, surge in micro lending. And it's not even micro anymore. It's quite extensive lending. In fact, from Ant Group, lending was their biggest revenue generator. So it became kind of unwieldy and under-regulated. So now this crackdown is going beyond Alibaba and Ant to the likes of Tencent. They have a significant financial services arms, whether it's WeBank as well as their payments platforms like WeChat Pay and Tencent Pay, but all the other ones started to follow suit as well because payments and financial services help link the other services that these big tech companies provide, whether it's gaming, social media, e-commerce, and the like. It's all connected by payments. So the financial arms got a little bit too big, and the government is cracking down. So this latest measurement is, cracking down on Tencent, on Baidu, or at least they've been summoned to this meeting by all the watchdogs, including the PBOC, the banking and insurance regulator, the securities regulator, the forex regulator. They brought all these companies in. Tencent, ByteDance, which is the owner, of course, of TikTok, JD.com, Meituan, food delivery, e-commerce, Didi Chuxing, which is ride-hailing, Baidu, of course, Trip.com, as well as Lufax, one of the leading fintech companies in China, among others. They were called in and given a long list of rectifications that they have to do in their financial services, including folding them if they warrant folding into a holding company that has oversight by the PBOC. And a number, I have the long list here of rectifications that include, of course, basically ridding themselves of practices that put them in a monopolistic position, as well as putting themselves into financial holding companies, and payment services have to return to their roots and must sever improper links to other financial products. So it's an unwinding of all these added financial services that these big platforms and smaller platforms have added to increase their revenue because they have the scale to do so. They had all those users, and why not sell them financial products?
So, Steve, how do those requirements compare to what they asked of from Ant or Alibaba?
Yeah, it's a good question because why was Ant and Alibaba, and if you want to extrapolate that further, Jack Ma, why was he singled out? Well, they are the biggest. Ant Group had the biggest financial holdings offerings, as well as, of course, they're the biggest leader in e-commerce. So they had the big one-off $2.8 billion fine on anti-monopoly issues, but the financial restructuring and the holding company that Ant has to be folded into is going to be probably much more severe and more longer lasting. And that is very much in line with what is going to be happening to the financial arms of Tencent and these other e-commerce companies. A lot of people extrapolated when they saw Jack Ma go kind of quiet after the Ant IPO was scuppered at the last minute last fall, that the government was going after Jack Ma because he's a sharp critic of the government and has been very outspoken. Why not take him down? Was he taken down as an individual? Well, this proves that this crackdown is more against the risks to the economy than risks from a single titan like Jack Ma.